Welcome to our halftime report. I'm so glad to see all the familiar faces in the room, and we actually have some good things to talk about today. Message from the lawyers and the regulators. Debbie's got a copy of these that you can use to go to sleep tonight. And with that, how many people in the room can relate to the look on this guy's face? I was kind of looking for some things to talk about, and after all the stuff that we've been through the past 2 or 3 years, from the pandemic to inflation to the Fed raising interest rates way high, anyway, today there's a bunch of positive things though that we're going to try to focus on today, and hopefully you'll leave today with what I would hope to be sort of a clear-eyed view of where we are economically and financially, because I think we're in a much better place than we were the last time we were together in this room. I think we got some... last time. Well, yeah, I found this, and it's like there's no wonder that this guy's got that look of concern on his face. And what we did, there's a bunch of people in the room that we worked for a lot longer than 15 years, which is what this picture goes back to, like 2008. But and really appreciate you all being here. But just going back to 2008, think of everything that we've been through together, from the global financial crisis to the global pandemic and coronavirus and all the economy shutting down and, runaway inflation, so on and so forth. But there really is quite a lot of good things going on. In spite of that red line is showing that, sadly, most of your fellow American citizens have been liquidating out of the great companies of America and the world and going to the sidelines because what do we hear in the news? Nothing but bad, right? I mean, it's awful and things are not going to get better, and then the election's coming up, and we'll talk about it, but not, as far as liquidating out, not you guys. I mean, y'all have been, I really commend you on the discipline that you've displayed and maybe the trust and confidence that you placed in our team to take you through some of these pretty difficult times. So we don't take that lightly. And I can't remember what's next. I think it's all the stuff So this is what we were looking at when we did our kickoff event the last time we were together in this room. It was nothing but red. We had a bear market in stocks, and at the same time we saw the worst bond market that's ever been recorded, with the Federal Reserve raising interest rates and raising interest rates and raising interest rates. Today there's a lot of great things to talk about, however, and so I hope you leave here feeling a little bit, we're feeling, I guess I'd call it cautiously optimistic as we look forward. We've come a long way from the October lows. We're not back to where we were, but we certainly have made some progress, and there's a lot of reasons why I think we're going to continue to make progress, and we'll go over some of those. Listen to I'm sorry, I didn't mean to talk over you.
Let's go.
I was just going to say you might have missed a lot of those gains if you did nothing but listen to these experts on TV saying that things are going to continue to get worse. So Dennis, talk a little bit about why we don't listen to these forecasters.
Yeah, so this chart's a great example of why we don't listen to forecasters. This chart is done by Bloomberg, and they put together what all the Wall Street experts, the gurus, have said is going to happen the next year. Their prediction on what's going to happen in the markets going forward, back to 2000 over here. And if anything, we can say that they definitely are optimists, right? You go each year, it's always positive, 5 to 20%. And we all know that did not happen. That's not even close to what happened. And so if we just, people continue to listen to them, but you even look at the last few years right here. Here's last year, they predicted about a 5% return. And Brian just showed you that did not happen by any means. And then going into this year, with all these gurus they had, for the first time in 23 years, they finally predicted a downturn in the stock market, in the U.S. stock market. And then we look forward to what happened, the exact opposite. But people keep listening to all these headlines and the gurus on what's going on. But you see, the U.S. stocks were up 17%, international up 12%, emerging up 8%, real estate not near as good, but still positive. 3.5%, and bonds, finally up slightly over 1%. So bonds are having a slightly better year. So instead of trying to forecast where markets are going, what we're doing for you guys is creating a plan and then just diversifying out and owning all these different asset classes. we don't have to forecast what's one of these asset classes is going to do, because if you look at that, I mean, up here up top is the larger returners for the year and the worst returns on the bottom. And does anyone see a pattern? There's not one. I mean, usually what's at the top is not at the top the next year. The top 2 or 3 at the top usually go down and vice versa. And we don't know ahead of time which one. But if you just own a piece of all of them, this white box, you're right in the middle. And that's kind of like I said, I mean, that's why we're trying to manage money for the downside, the upside take care of itself. And if you look over on the right, these last two, this just shows from 2008 to 2022. This left one is what was the return over that time period. Just owning a piece of all of them is towards the top. And then, right there. And then on the right side is the volatility, the up and down movement. How much, when things got bad, how bad did it get? When things are good, how good did it get? And it's towards the bottom. So much, not much more volatility than fixed income, but much better returns. And that's really what we're trying to do, is try to get rid of that volatility, but keep up the returns. And again, not having to forecast anything. And then kind of taking the next level, what we're doing, let's see if I can find is when things do really well, we've talked about a rebalancing. And we're paying attention to that because, again, it's probably not going to continue to be the best asset class going forward. And so like a good example is, like here, emerging markets equity, 2017 up 40%. Time like that, we'd take some gains off and then go reallocate it down in other things that didn't do as well. The next year it was last. And then you look, up here, REITs was first, and then it's last, and then it's first, and then it's last. So they're moving all over the place. So when it does well, we take those gains, reallocate back in everything else. Or if we're sending you money, we put it back in your cash to make sure you still have more cash for us to send you. So we're just rebalancing as we go. And so that's really how we've come up with, this is just what has actually happened in our portfolios going back to 1999. The returns going back, and I know this is a lot on there, so I'll blow up. Year to date, if not many of you in this, but 100% stocks up 15%, down to one of the more conservative, if you're in 40% stocks, you're about 7% up. So again, much better than last year, not completely making up for it. But importantly, one thing to point out is this right one is going back to 99. This is the average return from 99 to the end of last year. And again, just by being diversified, paying attention and rebalancing when things do well and reallocating and things like that. If you look at just stocks versus stocks, our stock portfolio is up 7.7 when U.S. and international are up 6 and 3. And that's really all that is just having a little bit of all of it and paying attention to take the gains when we got them is the main part of that.
So far this year, great year. 14th best year that we've seen start for stocks on the left-hand side over there. S&P 500 up 16.9%. And what we looked at here was, does that trend tend to continue over the next 6 months? And in fact, it does. If you have any kind of a positive return in the first 6 months of the year, that momentum tends to carry out. And you can see that with the yellow line over there, up 7.8%, anytime there's a positive first 6 months to a calendar year. Whereas if we have a negative first 6 months to any calendar year, that trend tends to carry out as well. So we've obviously had a very positive first 6 and 7 months to the year. Let's hope that trend continues, because that's kind of what the historical record says typically happens. And we've had that real strong return with lower up and down movement, which you may or may not have noticed, but we've had a lot less volatility this year. We only had 2. If you look at trading days where we had up or down movement of 2% or more in any one trading day, we've only had 2 of those kind of days this year. Last year we had like 46. So last year was the most volatile year we've seen since 2009, when we were trying to get out of the 2008 financial crisis, right? And then this year it's kind of been just nothing but steady Eddie, and And so what does that mean? Well, that's probably a really good sign for stock returns. We went back 22 years. I think we went to 2001. And in the yellow over there, you can see that when we're in a low volatility environment, like we are right now, that tends to produce a real solid return for stocks, on average about 17%. But if we're in a high volatility environment, and we counted that as any year where we've got 10 or more days of those 2% plus or minus days going on, like last year. But any year we have a lot more volatility, it's just a break-even scenario. So we're getting great returns, we're getting low volatility. These are all very positive indicators for where we are and maybe where we're setting up to go for the rest of the year. So pretty bullish signs here.
Those are my favorite.
That's right. And who's been worried about inflation? The inflation rate has just collapsed if you take a look at this. I mean, the Federal Reserve has raised interest rates a lot, and not to toot their horn, but what they've done or what somebody has done has absolutely worked. Inflation, was at 9% a year ago, and now it's come all the way down to 3%. I think the July readings came out today at 3.2%, which is about the 100-year average. So now we're finally getting back to something that feels maybe a little bit more, maybe a little bit more normal. So another good positive sign.
Yeah, we didn't have any for a long time.
And then what we wanted to do here is just give a little bit more perspective going back all the way to 1970. We went back 50 years and looking at not just inflation, but inflation and cash and stocks and bonds. And kind of focusing in, Dennis, if you will, on like the left there, the 2010, 2020s. I mean, we've seen a lot of, obviously we've seen a lot of inflation the past couple of years. And in fact, the 2020s inflation number is about what inflation did the entire, 2010, the whole decade of the 2010s. But some of the other things that I might want to point out is bonds have way underperformed cash over this, past 3.5 years. And that is very abnormal. If you look at every other decade, bonds have way outperformed cash, going all the way back to the 1970s. And I guess I'd end this slide by just directing your attention all the way down to the yellow and seeing that both bonds and stocks have far outpaced both cash and inflation. So I know a lot of folks in the room have went and put money in treasuries and money markets, and we're finally getting interest. We're finally getting paid in savings accounts or money market accounts or treasuries. But you may not want to hang out there forever, even though you may be earning 5. If inflation is 3 or 3.2 and you pay tax, are you really making any money? And if you look at the long term of what stocks and bonds done over the long period of time, over 53 years of data, may not want to hang out in cash forever, I guess is all I'm trying to communicate there.
A little more good news is we've seen economic growth continue to go up. I mean, you really don't hear about it much in the media, but here is the trend line that we'd like to keep the economy on. You see here's the pandemic low. We're about back up to that trend line. So pretty good growth. That's really good news for investors. Another one is we continue to have a strong labor market. On unemployment, the 50-year average is a little over 6%. Right now we're sitting here at, 3.6, right? 3.6% is what we're at now, so considerably lower than the average. And then the average wage growth over the past 50 years has been 4%, and we're right now at 4.7. So we're pretty much anyone that's looking for a job can get one, and the wage growth is higher than average right now, which, we're a consumer economy, they have more money to spend, that's a good thing. Another good thing for savers, at least, right now, is we saw the Fed, like Brian talked about, increased rates 5% last year. That's great news if you've got money in CDs and money markets and things like that. Bad news if you're a borrower, it's costing you a lot more now. But, kind of looking forward, too, is that I think right now we've got about a market's pricing in a 90% chance that the Fed stays still on September. So we might be done, who knows? They might do a little bit more. They're going to do whatever they can to fight inflation, but hopefully we're near the end of it. And if you look here on kind of the Fed's expectations, they're kind of expecting to start cutting rates as early as next year. And so the kind of the bad news part is, again, you'll start to see your CDs and your money market rates go down. But the good news is that's going to help your bonds. I mean, bonds are kind of like a teeter-totter. The rates go down, the prices of bonds go up, and vice versa. And so if we see them go down kind of what they're expecting here, I mean, it's kind of similar to 2019. We saw rates decrease like that. Bonds went up 9 or 10% in that 1 year. And we saw it here in 07 and 08. They went for 2 years, they increased about 7-8% per year. So when that's why bonds had a tough road right there last year. And so when we start to see those come back down, then you'll see your bonds really increase in value.
So we
again.
haven't had any defaults on bonds. I think
Right.
that's a point that I'd like to really make. There's been no defaults. And when we're rebalancing and we're taking money out of maybe some stocks that have done real well and buying bonds at today's 5 to 6% rates, and these are for high quality bonds, these are not for junk bonds, and then rates go back down and you to 2, I don't know where they're going to go. I can't predict that they're going to do that, but this is coming right from the Federal Reserve. They come back down to 2.5%. What do you think your 5.5% paying bond is going to be worth? More money, right? So,
Yeah, we're sitting at just over 5. Their goal is to get to 2.5, half of where we are. Cut it in half from where we are now.
so this chart is a little busy, but what this chart has to do with is consumer sentiment, and this is a little. This idea is a little contrarian, so bear with me a little bit. So we're talking about consumer sentiment. How is everybody feeling about where the economy is and where it's going, all right? And then what this looks at is what happens with stocks after 12 months after any particular consumer sentiment reading. You with me so far? So if we go to like October of 1990, everyone was feeling. And think about what's going on today. I don't know if I necessarily want to get a show of hands or anything, but when I talk with people, most people are just not feeling all that great, even though the economy is looking pretty good. Most people are still feeling like, yeah, well, when's the next shoe going to drop? What about the election? Everything's still kind of, I'm not real positive about what's going on, which brings us right over here. Here's where we are today, still at the low end of the range. So how good are you feeling about the economy and where we're going? And how good are all of your fellow American citizens feeling about the economy and where we're going? And what's interesting is, just look at like October of 1990, everyone was feeling awful about what's going on. Well, look, stocks were up 29% over the next 12 months. So don't base your decisions or your actions based on how you and everybody else is feeling is kind of the point. Remember 2008, everyone feels awful in 2008, after the great financial crisis. November of 2008, 12 months later, stocks are up 22%. Everyone was feeling awful a year ago when inflation was 9%, no end in sight, right? Couldn't even get some stuff, because of the supply chain issues and what have you. At that low reading there, stocks up 17.6%. So it's very contrary. And then go up here, the whole data set really is in that box up there on the upper left-hand corner. So if we look at all the sentiment peaks when everybody's feeling great, and you look at what the average return on the stock market is 12 months later, 3.5%. But you invest when when you and everyone else is feeling awful, so contrarian, right? Stocks up 24%. Now, I don't want anyone to think that I'm saying, well, obviously this data says stocks are going to go up 25% from here. There's a lot of things that are going to impact that, and we come about 25% in the global stock market since the October lows. So we still need to be pretty smart about what we're doing going forward. But the point is, don't let your feelings about, or especially when you're tuning into the news, when we got this election coming up, about how awful everything is. I mean, if it really is that awful, then this is a pretty strong contrarian indicator, and you can see the data for yourself. And I think that this is what this pretty famous gentleman up in Omaha is talking about on this next slide. Buffett says, "Hey, it's time when everybody else is feeling all great. Maybe I can remember I went to Chicago one time and a cab driver was giving me a stock tip on like an internet stock back in the back half of the 90s, and I was like, yeah, I don't know if I'm going to buy into that. But be greedy. But he says be greedy when everybody else is feeling awful. So and I think that might be a little bit about what Warren Buffett's talking about there. So who's read about it's the end or it's the death of the 60-40 portfolio? Anyone seen those headlines? I mean, we saw this. They called for it last year, the 60-40. I mean, we had a very bad market in stocks. We had the worst bond market ever recorded. And so all the headlines come out and said, this is the end. That's old school 60-40 portfolio. Diversification just don't work anymore, right? And we heard that back in 2008. We heard that in 94 was a very difficult bond market. Bonds did not hold up when stocks didn't do too good in 94. saw the same in 1974. And in this room, the last time we were together, we talked about the fact that we've never seen back-to-back double-digit negative returns in a 60-40 portfolio. Well, look at the number. It's up 11% so far this year. Go figure. So the 60 portfolio is not dead. These are the Armageddonists. I saw Kathy Ford. I don't know where you are, and I don't want to pick on you, but if you're getting this stuff from like Agora Publications or who's that other yacht? What's that guy's name? Stansberry. The world's not ending. It's not the end of the 60-40 portfolio. I mean, these are the Armageddonists trying to get you to enroll in their newsletters, or, the media is trying to get you to, click on the thing, and they sell advertising. They're not in the business of helping you make smart choices about your money. So if you can, try to tune them out. I know they're very persuasive, and they sound smart, but I don't know how to put it. They don't have your best interest at heart all the time.
Bad news is out there every year from them. All right, the fun next quote-unquote crisis coming up. I know a lot of you are already thinking about this. We're already starting to get questions. We talked to a prospective client a couple weeks ago. He's like, well, election's coming up, maybe I'll wait. So we're just kind of covering, do elections affect stock market returns? I'm going to go into a few things, but I'll tell you right now, no, they don't. It doesn't really affect it. But the media is going to make you think it is. We're going to have a long 12 months again, and it's going to be on there over and over and over. And just kind of some examples. This is back in 2016, we saw a lot of this. The hedge fund says it'll crash if Trump wins. I think the consensus on most of what we saw in the media was 20 to 40% within days, and it'll take years and years to recover. Was a big thing, a lot of what you saw. And a year later, best one-year return since 1944. So it wasn't right. You go to the most recent election. You see here that it'll be brutal for the stock market for the simplest reason. And oddly enough, you go read this article. He gave 5 reasons and didn't say which one was simple. Never mentioned it, but it doesn't matter because he was wrong. It was even better after that one. And so you're going to see the same things. I guarantee you every election year we see the same exact thing. So you're going to have these for at least the next 12 to 14 months. You're going to see it over and over and over. So we just went back, let's look at the data, just going back to 1988 to see what has actually happened. And so this is going back on election years and the year after. In the blue is what's happened on election years. Again, going back to 1988, starting here at the bottom. Only 2 years were negative. 2000, the dot-com bubble bust, and 2008 in the financial crisis. And I think we can all agree that had really nothing to do with the election, or who won or who didn't win. It was really what was going on at the time, was a large majority of that. But you see the rest of them positive on election years. So, nothing great. They averaged about 5.5%. Even with those losses in there, still had about an average of 5.5% gain on an election year. More importantly, you look at the year after, which is, it's kind of a month or so later. Year after, really, really well. The year after that. No matter Republican, Democrat, who won, there's headlines in all these, and actually it's about a 30% return. Again, going back to 1988, the year after election, it averaged a 30% return. So it's one of the best years we've seen overall on average. So it's kind of the opposite of what we're hearing election after election after election. And, well, let me say this too, before we get it, sorry. You own about 12,000 stocks in your portfolio, for all of you, based, all across the globe. And just remember this, they're trying to do their best. They're trying to make the most money they can for shareholders in spite of what the government's doing, not because of what they're doing. So they're working around what's going on. They're going to make money. And they're going to do what's best for their shareholders no matter what. They'll figure out a way.
I mean, before we get into that, I might just make this point that and I know the media is going to get us all worked up. I mean, I'm not immune to it. But if you mix your investing with your politics, you're making a mistake. The data is just crystal clear. I mean, go study it after this meeting. Just go study it. as far back as you can. It's just not wise to mix those two things. But because again, we get us charged up, we get emotional, and so to be objective and take a step
I don't
back.
think people get emotional about politics. I don't
All
know
right,
what you're talking about.
so it's the 10th of August, and I just thought we'd take this opportunity to recognize it's the 44th anniversary. I know this is going. I'm a nerd. I mean, this is going to sound nerdy, but this article that came out in Business Week 44 years ago, saying this is the death of equities, is sort of a famous little thing. Everybody in our business knows about this article. And the article, was published back in '79 at the end of the '70s, and it was going through all the bad stuff that happened in the '70s. And you'll recall some of these things. We had Watergate. Not only that, but the Vice President, Spiro Agnew, went to jail for income tax evasion. We had, a debacle in Vietnam. We could not get out of that war. We had inflation much worse than what we saw here. I mean, these were all, just disastrous, unsolvable problems, and therefore they're permanent, and therefore stocks had just done horrible, and they're going down, and they're never coming back. And that's basically what that article said. And just to recognize its 44th anniversary, because it was very effective. This article and articles just like it drove people out of owning the great American businesses for years. Some of them left the stock market for the rest of their lives. So I just thought we'd sort of recognize the 44th anniversary of this article by looking at what really happened since then. And you'll be amazed to know that you could have bought the S&P at 107 on the date of publication of the death of equities. It had a dividend yield of 5.6%, which sounded good, but nobody wanted that because you could get 10% in a CD. Look on your phone. Where did the market end today? It ended yesterday at 44.67. Now, if you divide 107 into 44.67, that means that your money, ignoring dividends, which was significant, your money increased 41 times. I mean, think about that. 41 times something is something. I mean, Mike, what if you had 41 times more spouses than you have? Broke? What if you were me and you had 41 times more ex-spouses than I have? That's broke. But what if you had 41 times more money than you had? And what if you remembered Buffett and you said, you know what, I read that article, I'm going to be brave when everyone else is fearful. And I put just $10,000 into the S&P that day, and I reinvested my dividends the way everyone in this room does, or most of the folks in this room reinvest your capital gains and your dividends, and you paid taxes from another source. That $10,000 that you put in on the day that Business Week said they're dead and they're never coming back is worth $1.25 million for every $10,000. So thanks a lot, Business Week. Thanks, Armageddonus. That was excellent. That was great advice. I think I'll do that again. Which sort of brings us back to this slide we looked at the very beginning. So while the red line shows that most of your fellow Americans over this 15 years, which were full of lots of problems, right? Again, global financial crisis, pandemics, runaway inflation, so on and so forth. And that red line is illustrating what most Americans have been doing, and they've been in net liquidation, getting scared out of and selling out of the shares of the great companies of America and of the world. And all the while, what we've tried to do for you guys, because again, most of you guys in the room are reinvesting your dividends and your capital gains. We're just accommodating those people. They want to panic out and sell. We're taking those shares off their hands at ever more attractive, values. And so what we've seen, at least in the portion of your money that we've got allocated to U.S. stocks, the S&P 500, we've seen a tripling in the value of that money, while most people are down here going to cash, and for most of the 15 years they made 0. Now they're making 5, but that ain't gonna last. So look, man, we know it's been no walk in the park, and we really, we commend you for the discipline that you show there. And no one in this room was part of that red line. everyone in here participated in the increase in the value of the shares of the great companies in America and the world, and we appreciate the trust and the confidence you've given in us to help you along the way over this period of time.
I've got to point out that one little thing right here. When we're looking at this, this is too good to point out. As Brian said, this red line is people taking money out of the market. If you look, it really accelerated right here, 2020. You look where it started, right at the bottom. As people were hurrying to take money out, it was skyrocketing up. And then you look at the peak, where people start putting it back in, right at the top. You can't make it up. I mean, it happens every time. So I know this is, for those of you who have accounts at TD Ameritrade, I know this is a pretty hot topic. So just kind of back up on what's going on is Schwab purchased TD Ameritrade back in October of 2020. This is just now going through. So the whole consolidation of it and everything just starting to happen. I don't know if any of you are concerned about it. They've done this many, many times. If you don't know, I started at Waterhouse Securities, which was then TD Waterhouse, and that combined. And then they were bought by Ameritrade, which became TD Ameritrade, and that combined. And then Scottrade went into TD Ameritrade. So they've done this many times. They know what they're doing. So it's nothing new to them. Just wanted to point out a few things. So what's going to happen is, if you have an account at TD Ameritrade, that's moving over to Schwab on Labor Day weekend. And so then TD Ameritrade is gone. Kind of sad. And then, so there's really nothing needy to do. There's kind of logins, and if anyone has any questions, I'm having Darlene and Kevin come up. They know more than I do. But so really for the movement, everything's moving over. Positions, cost basis, tax information, all that's going over. And then so on Friday the 1st, then your online access to TD Ameritrade will go away. And then they'll move all the data, and then you'll be able to log into Schwab starting on Tuesday. Is when you'll be able to log into your Schwab account. I've got accounts at both. Carrie and I do. Have accounts at both of them. I think Schwab's better technology. It's a little easier. You can link accounts easier. I like it. You will get a new Schwab account number. So it's really not that big a deal unless, like, if you're sending a direct deposit from a bank or something like that where you've kind of initiated it and sending money in, you will need to update that with your bank. But for everything, which most of you were, if we're sending money out monthly, we're doing on demand, anything like that, that's all moved. There's nothing you need to do about that.
Yeah, so to wrap things up, I mean, there's a guy named Carl Richards. I don't know if you ever see his sketches in I think, New York Times or, yeah. And hey, let's focus on the things that matter and the things that we have some control over. So as it applies to what we're talking about here, let's if we haven't revisited your plan lately, let's have a plan in place that fits you and your goals and your objectives and your cash flow needs, so on and so forth. Let's structure a portfolio around the evidence, not based around the forecasters or where some guru says things are going to go for the next 6 or 12 months. Let's diversify broadly so we can make it through any market environment like the really tough environment that we saw in 22. Let's focus on some of those things we can control, like risk and cost and tax, and you guys have done a great job of sticking to your plans, and we appreciate that. Our whole job is to help you make the most of your life. So get on the phone or whatever, and if you need to get in and revisit your plan, I mean, the only reason we're here is to help y'all make the most of your hard-earned money. So, hey, thanks for being here, and thanks for being our clients.
Thank you all.